Hey, good morning, everyone. Marty Missouri here, Monday, November 2nd, 2020. Keeping my promise to get back to you within 48 hours with the rest of the video, although it won't be the rest of the video. I'm going to keep this one pretty quick. Wanted to just do the natural follow-up on the illustrations that I showed you, or the information that I gave you with regard to the transactions, adjustments, trades that we've been making in the second half of the year. So want to bring you up to date just on the basic core portfolios results this year. For you new clients, and we've agreed to work with a few new people this year who haven't experienced the last few years with us, I want to make sure that you know that being conservative for us is not a perpetual position that we take. It all has to do with macro conditions, our fundamental, our technical analysis, and so forth, which instructs us currently to have a real conservative bent in our portfolios, as well as to introduce the kinds of asset classes that do well in light of what we believe the policy environment is going to be going forward. Zero interest rates, suppressing the dollar, and so on. So I'm going to show you a little bit of history. You just go back to a couple of periods, and we'll leave it at that. And then a little bit of market history to help on perspective as well. So what you're looking at right here is our 100% core portfolio, meaning this particular account, this particular portfolio is completely in our core. It happens to be a non-taxable account. That's either going to be a retirement plan or a nonprofit institution. So we can do whatever we need to without worrying about taxes. We have quite the number of accounts that are taxable accounts that have legacy assets that would have imposed a great deal of capital gains taxes if we were to make all the adjustments that we need to. So those are a little slower moving, getting into the full core as we make adjustments, unless, of course, the individual client is willing to go ahead and bear the tax treatment of a big kind of wholesale rebalancing. So that's always the case. There's always going to be these portfolios. You folks out there, you know who you are. So up until just recently, that has equated to some pretty notable outperformance because we had to leave more tech exposure in those portfolios than we desired to. And tech has continued to do well despite what we believe is a pretty risky sector to be in right now. Now, consequently, the score of the portfolio, because of the added tech, has us hedging a little bit more. So we're going to be a little more protecting of that on a relative basis, meaning the number of put contracts are going to be more in that particular portfolio than the core allocation because it's got a higher score in terms of volatility. So anyway, getting too far into the weeds, I know. So those of you who look at this and you say, hey, I did better than that, or hey, I've done worse than that, it has to do with your allocation relative to legacy assets that we have to hold, or we feel like we have to hold right now. So this is from the beginning of the year to the market peak, all-time high on September 2nd. Our core portfolio, which is the blue one here, was up 3.18%. That's the blue bar. Notice this one doesn't show any color. That's the S&P 500 equal weight, flat as a pancake, up 0 as of September 2nd. The S&P 500 cap-weighted index, the one everybody talks about, heavy in tech, I think heaviest ever, and highest concentration ever in 5 stocks. So it was up over 10% at that point. If we had a benchmark, it would be this one, the MSCI World Index, because our portfolios are global. It was up just over 5%, and then the Dow was up barely at that point. The graph, you can see that when the market fell out of bed, this particular portfolio, again, 100% allocated to our core, captured about a third of the worst down here, which was 37% for the averages. So it was down about a little over 12%. At that point. And then notice we had this nice little jump right from there to there, and that was just some out-of-the-money call options we bought right here at the bottom. This, clients, as you know, has gone way further than I anticipated. History and the fundamentals would have suggested that right in here somewhere, the market would have rolled over again, made a new low, that sort of thing. But of course, we have the Fed, doing things that we thought were illegal, like buying corporate bonds, but they figured a way around that. That's helped the market, as well as huge, huge, huge fiscal stimulus, which really makes a difference in the economy. In here, late in that first half is when we really started employing asset classes that were consistent with our longer term thesis. So we started buying more commodities exposure. So notice in here that the portfolio pretty much just allowed the stock market to catch up to it. And then in here, we maintained a pretty good gap between that blue line and the rest of this. Now the S&P 500, because of all the tech, just kind of ran away from everybody. But relative to the major averages, we were pretty much holding in there pretty good and showing some upside. Dollar rallied, commodities had a tough time in here, and that was reflected in our relative performance. So again, that was to the market peak. Now, let's take a look at what's happened since the market peak. So the market's rolled over a bunch. The S&P is down almost 10% off of its highs. NASDAQ down well into correction territory. So the portfolio is now, as of Halloween, as of the 31st, is down 1.34%. But you can notice that all of the averages took a much bigger hit than did the portfolio, and hence the conservation that I'm referring to. And then to see how that graph looks. So again, we know what we did here. So right in here, you can see that the portfolio now is taking on more volatility because it has more beta, or has more assets that'll move. Not necessarily with the stock market, however. We've had days where the market was down a bunch and the portfolio was either flat or up a little bit. We've had days where the stock market was up and the portfolio was flat or down a little bit, and that's because almost a fourth of it is in commodities, which we think is very important to own right now. But you see right in here, among the averages, the portfolio is outperforming everything that we illustrate except the S&P 500, but it's coming close very, very quickly. And by the way, just to put this in further perspective, right now, and that's not reflected in here, the portfolio, the core portfolio is up 0.87% on the morning. The S&P is up 0.82. The NASDAQ is now down 0.25%. The Dow is still up 325 points, which is 1.23%. Save for the Dow, the portfolio actually is doing better than the market so far this morning, and you're only down 0.5% on the year. So these things in this environment can change very, very quickly. Literally in the next 2 weeks, we could be up, high single digits to low double digits and so forth. And if the market rolls over, we're looking to capture much less than that. And that's pretty much the mode we're in right now, folks. Okay, so I wanted to show also on the more conservative side, a conservative retirees portfolio, as of the peak, was up 2.92%, the peak on September 2nd. Note, though, the big difference here, this thing was down less than 5% when the market was down nearly 40% in terms of the equal weight index. And so we didn't catch as much of a bump because we didn't go as aggressively. Still, we're meandering higher here. As you can see, still, third best among our averages with a very conservative portfolio. So this is one of our more conservative allocations. What that means, folks, is that it's still the same core portfolio. It's just that less money has been allocated, less of a percentage has been allocated to our core, as opposed to the previous portfolio I showed you, which is 100% allocated. The remainder of this is going to be in cash right now, very, very short-term corporate bonds to pick up a little bit of yield and so on. And now year to date, as you can see, the more conservative portfolio did give up a couple of percent, but it's still up on the year so far. And the other ones have rolled over except for the S&P 500. The Dow is down, looks like 7-8% at this point. This portfolio is up roughly just under 0.5% so far today. So again, tomorrow we could run this and it would be a better looking illustration. So less volatile. Here you can see the market rolling over. You can see the blue line, which is this one right here. You can see there's where it gave up a little bit, but boy, nothing like the market. And again, to repeat myself, this is exactly what we're attempting to accomplish at the moment. So for you new clients who just joined us this year, again, you've experienced us being conservative. I just want you to know that's not who we are perpetually. Who we are perpetually is a firm that does deep analysis and allocates portfolios based on what we view as the right risk reward setup. So in 2019, we did pretty well, and I want to show you the graph on that. We're up 18.45%. Underperformed the four averages that we track here, but that underperformance came in the second half of the year. That's because we started hedging right here in late August. So reason being is our macro index, and I'm going to show you that real quick here in a second, began to roll over and told us that now odds favor recession going forward. And of course, that was quite a ways before we even knew, before I could spell coronavirus, as I like to say. But our assessment, both fundamentally and technically, said time to get defensive. So we didn't really change the portfolio then. We just added an options collar. And consequently, you can see we literally eliminated most of the volatility. Just soon after we did that, we were up over everything on the year because the market came crashing down below our portfolio and stayed there for, a month or so, and then started coming back, dipped again in October. Right in here, we were besting everything as well. And the market just took off the second half of the year. So, and again, that was the weight of our hedging, which is going to do that every time. But nonetheless, we still had a decent year, really by virtually eliminating all of the major risk the second half of the year. So the culmination of the 2 years is from January 1 to current, that core portfolio is up just under 9%, actually outperforming the Dow, interestingly enough. Tech been on fire. That's why the S&P is up almost twice as much. The foreign index is up over 10, and then the S&P equal weight up over 10%. But putting it in perspective from the standpoint of volatility, so here we were at the beginning of the year. Here's the market leaving us behind, and then kaboom, here's the market just crashing down. But notice right in here, the portfolio was still in the positive from January 19 to current, and when the market came crashing down. So then the market came back up, and of course where we stand right now. But for the almost 2-year experience, up about 9%. But folks, what we aimed to accomplish once we started hedging right here is exactly this. We see a tremendous amount of downside risk in this market that is still there, that while it may absolutely not come to pass, we need to protect against that. All the while, understand what probabilities are going forward and make the proper adjustments within the portfolio so that we can make some money to the upside while protecting against the downside. And then lastly, with the performance numbers, with you new clients in mind, we will be plenty aggressive when conditions suggest it's a smart thing to do. That was how we felt about things in 2017, and therefore we saw a nice 21.59% start to finish return, outperforming the S&P 500, but not the Dow. The Dow had some components in there that did very well, but we were pleased and not surprised by 2017 based on our analysis. Just one more chart today, and then I'm going to let you go, and I'm going to circle back with much more here later in the week. So this is the S&P 500, the white line here, from 1997 to current. These numbers are the scores just inserted here at different places of our macro index, BWA macro index. We actually invented this back in 2017 and have been scoring it every week since, and then back tested it at key points back in here. So clients, you new clients as well at our interviews, I like to talk about, and I was ironically back in here, I was talking about this phenomenon. And what I was saying is that when our index rolls over, we're probably going to need to start getting conservative, and we're going to look like idiots for a while, because the things that inspire us to get conservative inspire the policymakers to get very, very busy. They hate recessions. They, I think, understand the necessity of them, but they don't cater to that necessity when they're in office. They try to mitigate, eliminate, circumvent business cycles. They tend to fail, and their efforts tend to just make it worse because they suck people in and so forth. So here was before the tech bubble. Our index rolled over, market rallied. Before the real estate mortgage bubble, our index rolled over, market rallied big time right up in there. But then it rolled over in a big way. In each case, and I've shown you these a lot over the years, you go down a bunch, you retrace a bunch, and then you roll over. You go down, you retrace, and then you roll over. You go down, you retrace. I'm back up here at the right. You don't roll over. You just keep going, or do you roll over? And that remains to be seen. But my point here, folks, is that conditions, -6 isn't bad, but we have to put it in the context with the fact that that comes by way of an enormous amount of money printing and stimulus. So we have to keep a watchful eye there. Also, what I wanted to point out, and then I'm going to close, is you may be thinking when you look at this volatility, you could say to me, hey, the market always comes back. 2017, we went down since then, but we're back up and so forth. Well, yeah, but when we're talking big, bad bear markets, okay, and I could show you this for 100 years, but here's where the market peaked in 2000, okay? So, the market's going down. A lot of, traditional advisors say, oh, no, stay in the market for the long term. It always comes back. Well, they're right. It came back. It came back and peaked again 7 years later, got just to that peak, and then rolled over for a 57% decline. This was about a 50% decline. And, yeah, sure, it always comes back. Well, start to finish, folks, from here to here was 13 years, particularly your retired clients, right? 13 years to see the market come back is a long, long, long time to be patient. Right here with the just before the worst bear market and recession since the Great Depression, we're talking, a good 6 years before we got back to that point. So folks, we need to be very, very careful with this narrative, that buy stocks, hold them for the long term, so on and so forth. I was raised that way, 36 years ago in the industry. Well, my experiences and my studies, and I started in 1984, but studied, history long before that, says no, when the conditions are similar to what they are currently, and the market's at all-time highs, and valuations are at all-time highs, and interest rates are at all-time lows. This is anything, I mean anything, but a bullish setup for stocks. The only thing bullish is the propensity to print money via the Fed and to spend money via the federal government. We want to take advantage of those things, but we also want to understand the implications on currencies and commodities. Those are the fundamentals we want to take advantage of. And then, focus on certain areas where the government's going to be spending a lot of money. I'll leave it there. Thank you, as always, for watching and listening. Be back again in a couple days. Bye-bye.